So let's look at QuickBooks for lending company. So a lending company probably is engaged in the business of giving cash to their customers as loan, or some of them engage in cash advance, salary advance, business loan, personal loan, fixed asset loan, or whatever kind of loan that they engage in or they give out to their customers. And then why some companies are limited to just lending at their core operation. So others can also extend to collecting deposits from their customers. So meaning that just to make finance easy for them or to reduce their cost of funds, they collect deposit from their customers and then are able to lend it to other customers that want the money. So why the interest they pay to the customers that they give the money to as loan is quite high. They are able to pay interest charges to their customers, the ones that actually give them the deposit. So for a lending company, we're looking at two set of people. The first one are the customers who give you money as deposit. Then we also have the second set of customers who are the borrowers. But we will be focusing more on the borrowers because this QuickBook is designed for lending company. But at some point, I will try to put a touch on how to record deposit from other customers and then how to also track the interest charges on their deposit. So let's look at the outline and what we'll be discussing in this video. We're looking at QuickBooks for lending company. So some of the outline here are how to set up chart of accounts for a lending company, and then how to add your interest income, how to add loans secured from fund providers, and then how to add your cost of funds, how to add your loan receivables, how to add your savings. That's if you collect deposits from customers, and then we're looking at interest charges. So we the interest charges here and interest income, they are not the same. The interest income refers to the interest on the loan that you disburse or you give to your customers, while the interest charges here refers to the interest you pay for collecting their deposit. So it's the difference between this interest income and interest charges that will tell you whether you're actually making profit or not. That's why we now have our net interest income. So we also look at how to create personal loan, which are your products. You know, for a lending company, your products are the personal loan. So some of them might actually come with a custom or bespoke name. No matter the kind of name you call it, it's a loan. So you can classify it as a personal loan, a business loan, and also how to add relevant interest charges, meaning that whenever you give out that loan, how do you calculate the interest payable on that loan? So the next one we have is your bank account. So how do you add the bank account for loan disbursement? Some might have separate bank account for loan. Some might also have the same might use the same bank account for both loan and deposit. Others might have separate bank account for loan and another bank account for deposit when customers pay in. So I can as well come here and say add bank account for savings deposits. Then how do you create a customer account and their receivable balances for both loans and savings? You can also add documents showing the customer's profile. How do you create department or categorize your lending business into personal and small business loan or savings and loan? So these are different departments. As a loan company, you're supposed to categorize your business into different segments. Then how do you create your vendors and their payable balances? So in this one, we're looking at the the service providers and also the product suppliers. So for you as a lending company, what's your product? Your products are your personal loan. So some of your vendors are also your bank, the bank that you source your loan from. If you have a finance company that you get your money from, if you have an institutional investor, an institution, so most likely your creditors, the people you owe. So and then if you have investors, investors are not vendors. Investors will be classified under equity. So here we also look at the direct cost. What's your direct cost as a lending company? Your direct costs are the cost of funds from these financial institutions. Your direct costs are also the interest expenses on customer savings and any other costs that are directly tied to the business of lending. Then, how do you create invoice for loan disbursement to customers? How do you create invoice? How do you track interest rate charges in percentage? How do you also track payback period? Now, one tricky thing about the use of invoice for loan is that if you think that it's the same invoice customization that you need for a normal retail based business, you will probably be wrong. So that is not correct. So you need to take account of that. It's very, very important. And then how do you create receipts for customers' deposits and savings and interest payable? Then how do you receive payment? So when your customers start paying back for the loan that has been disbursed, how do you record such a loan settlement? And then how do you record regular business expenses and banking transactions? We're going to be looking at how to record check payments, transfer fund, use register for your report, and then reconciliation. Then finally, we'll be talking about your financial report. How do you check your income report as a lending company? How do you look at your expenses? How do you look at here for lending company? You don't need this. So we'll probably be looking at your interest income and charges. So you can look at report on interest income and charges, and then your profit and loss by department or category, balance sheet, cash flow. Then you can also generate a trial balance too. Trial balance is also very important. So you can quickly come here and pick your trial balance as a lending company. So let's move to the software properly for demonstration of each of these guide. Now, this is a demo company that we've created for a lending company. So the first thing we'll be looking at right here is set up chart of account for a lending company. Now, one thing it's very, very important, and I've always said this repeatedly in my video. If you want to start using QuickBooks for any industry, the number one area you need to pay attention to is your chart of accounts because that's the feature that differentiates your customization for a lending company from a real estate company, construction company, insurance agency, private school, manufacturing, wholesale and distribution, whatever kind of business you run, that is exactly what where the differentiator comes from. So we were looking at the chart of account of a lending company. Now, chart of account of a lending company is actually a little bit tricky, and I need to pay a lot of attention to the my customization and how I'm going to be customizing this QuickBooks for chart of account. Um, Customizing chart of account for this QuickBooks, I mean. So the first one we're going to be looking at is the income. So what's the income of a lending company? We're going to edit this to interest income. That's the first thing. Interest income. Now, where is interest income coming from? So this would be interest and on loan disbursements. So that's interest income, number one. Now, you can actually differentiate different types of income. So for this interest income, we can come here and say interest income on personal loan. So interest income, personal loan. Then I'll click on OK. Then we can change this to interest income business loan. So we have different type of that's the source of income. Major source of income, interest income on personal loan, interest income on business loan. So we've added that. Then you have loans secured from your fund providers. So it's also important for you to track loans secured from your fund providers. So which is a loan. So you come to loan. Remember the importance of chart of account. Account type has to be properly selected. So this would be loan secured or secured loan. Secured private loan. If you don't want to call it secure private loan, you can call it um, secured bond, corporate bond. Same thing, corporate bond. These are also debt instruments. And then you click on OK. If you have an existing corporate bond, as at the time we're setting up this QuickBooks, what is the value of that corporate bond? You have 12. So what does that mean? It means that as at 31st of December 2022, we still have a balance of 120 to pay. It doesn't mean this is the actual value of that bond. After you've paid part of the bond, depending on the agreement with the creditors, this is what you have outstanding as at 31st December 2022. So you quickly enter that as the value of that. Now, when you add a secured corporate bond. That also gives rise to interest payable. So we'll discuss that. So that's the interest on this corporate bond. So the total loan automatically becomes this, which is the principal portion of that loan, and then you can also have the interest portion of that loan, which you're supposed to pay back. So let's move on to the next one. We have your cost of fund. As a loan company, for taking this money, it leads to cost of fund, which is the direct cost of the loan that you have secured. So we'll come here. Your cost of fund is directly tied to your line of business. So it's a direct cost to you. So you come here, you put your cost of fund, and then you click on save and close, which is a direct cost to you. Then we have other type of costs like your loan receivable, which is your account receivable. So we'll discuss that. So let's go add our customer. We can quickly edit that. The moment you add your customer, it adds account receivable automatically. So we'll look at that when we add our customer to the system. Then we have our savings as a product too. We're also going to add our savings. Now, how we're going to add savings to the system? Every money you collect from your customers as deposit and not your money. The same way you go to the bank to deposit their money. So that's going to be a liability. So you have that set up as a liability. So we'll call it savings deposit. So if you have money that you have collected from your customers, you can actually impute them right here. Save and close. So savings deposit. And again, we have interest charges, which is interest expenses. That's also a direct cost to you. You come here, you add interest charges. So this is the money you pay to your customers for the deposits or for the savings deposits. So you call it interest expenses or charges. Click OK. Oh, sorry, this is supposed to be direct costs. So you can see that we've been able to customize a few things in our report. We have our interest income, which is personal and business loan. We have our cost of fund, we have interest expenses, and then we've added our secured loan to the system. So if there are other items you want to add on that in chart of account, make sure you do that. This is very, very important. Now we're going to add personal and business loan. So these ones are our product itself. So the same way you add a product for a retail-based company, you also need to add a product for a credit on and loan company. So what is their product? Their product are personal and business loan. So you come back to item, you select item list right here, and then click on item new. So this time their product are services. So you come here, put personal loan. Now, personal loan goes to interest income accounts. Is that correct? No. So this is where the trick comes in. When you give out personal loan, this is what happens in accounts. So before you start customization in an accounting system, you need to be sure that your customization align with the basic accounting treatment. If it doesn't align with basic accounting treatment, then something is wrong somewhere. If I come here and I map it to interest income. This is wrong. What does that mean? It means that anytime I disburse loan of 50 million to a customer, system automatically creates a receivable, which is fine as a debit leg. Then it recognizes that 50 million as interest income. Is that correct? No. So basic accounting treatment is saying that whenever you disburse loan to a customer, two things happen. Number one, your bank account is reduced, which is your bank balance is reduced. So the entry is that you have to credit your bank balance or bank account, and then you're going to debit your account receivable. So what happened is that this particular loan has an effect on our bank account. So the best thing to select here is the bank account we use for disbursement. So let's go back to list, chart of accounts, and then I'll go to accounting, new. So we're going to add our bank account, which we use for disbursement. So our bank account here, let's assume we use Bank of America, and then opening balance, what we have in that account, and then this is balance. So you need to add your bank balance to the system. Can you see here? So you are going to connect every loan you disburse to your bank account because the money comes from the bank. So we quickly come here, Bank of America. So what does that tell us? The moment you create an invoice for a personal loan that you've disbursed, the balance in this account automatically reduces, and then the second leg becomes receivable, which is the value of that loan you have given out. And then you can also pass automatically. You can also add your interest charges. Now it is the interest charges that goes to your interest income. So when you add your interest charges to what happened, your receivable balances is debited, meaning that the receivable balances is made up of the principal portion, personal loan, and the interest portion. That's what the customer is supposed to pay. And the second leg of the receivable balances goes to your interest income. So we've added personal loan. So let's do interest on personal loan. When we add interest on personal loan, we're not going to use service. We're not going to use service to make the whole process easy. Because it's measured in percentage, we're going to use other charge. So then you call this interest on personal loan. Then let's say interest on personal loan is 5%. So where does it go to? Interest on personal loan account, which is correct. So you click OK. So this is how we set up. So this process also works for business loan. So let's go back, new. So we're going to add our business loan, and then business loan Bank of America, which is the one it's coming from. We click OK, and then we can as well add interest, which is other charge, interest on business loan. So here you have interest on business loan. So here could be like 4.5%. Now, most times interest on business loan is a lot lower than personal loan because the risk on personal loan is higher than business loan. So you click OK, you can see right here. So sometimes it could be higher, it could be lower. So, but wait, that's not the essence of this. It is just for you to understand how the setup is done for both personal and business loan. So we've added our product. The next one is our bank account for disbursement and loan. So we've added our bank account for disbursement. You can also add your bank account for savings. So let's assume you want to add a bank account for savings, and you're calling the bank Wells Fargo. So you come here, you have your bank account, and then Wells Fargo as a bank. So if you have a balance in that account, you can come here and input the balance in that account right here. You click on this, you click OK and save and close. So you have your bank balance. So this Bank of America is for loan, Wells Fargo is for deposits. Bank of America is for loan, Wells Fargo is for deposit. But you can as well use one bank for both loan and deposit. But it makes more sense for you to have an account dedicated to deposit and also another account dedicated to loan. It makes your report easier so that when you are trying to check private stock transactions by deposit, you're able to look at the specific bank account that is meant for that. And if you want to sort a bank account by loan that have been disbursed, it's easier for you to do that. Then we have how do you create customers account for both receivables. So here we're looking at loan and savings, loans and savings. So there are two things we can do on this system right here. We can lump all the customers together, or we can categorize all the customers by loan and savings. But the question is, what if some customers that have given you deposit also come to say, okay, I want a loan? So I don't think it's a must that all the customers has to be categorized. You can actually input them one after the other together. So I can say SMB business. So this is a customer on the system. I can as well click on OK. If this customer has an ongoing loan, let's assume this customer is owing us for loan that that they have collected so far, you can actually enter it as opening balance. Now, one other setback of entering this as opening balance is that it's going to categorize this as it's going to take it as uncategorized income. So it's going to take this as uncategorized income. So because we meaning that's an income for the previous period before QuickBooks setup. So here we would have this 25,000 USD. So what does that mean? It means that at the time we're setting up, this particular customer is still owing us 25,000 USD, which is the part of the money that they collected as loan. You can also come here and then you impute that on the system. Okay, so let's move on to other areas. You can have different type of customers. Let's add more customers here. Mr. John Smith. So this one has no balance. We add that to the system. So let's look at other areas. Then, how do you categorize your loan business by department, personal loan and business loan? So we've talked about categorization of your business into segments using class. You go to edit, select preference, accounting, and then you activate class tracking for transaction. Then you click OK. So if you go back to your list, you have your class list already um, activated. So we can call this personal loan segments, and then we can as well call this, so that's business loan. I mean, we can as well call this personal loan. So that's business. This is business loan and personal loan. The overall essence of categorization like this is we're able to generate your profit or loss by class. So you can see the profit and loss of your business loan department and profit and loss of your personal loan department. And then if you also have maybe like an admin department, so you don't allow transactions to be categorized. So you can come here and say admin office. So that means any transaction you post that is not personal or business loan, you can eventually take it to admin office. This most likely will be a cost center to you as a business. So we have our vendors and payable. So who are our vendors? Our vendors are the companies that have provided loan to us. So we'll quickly go back to home, and then your service providers are also your vendors. So we can come here, add the vendor. You can say money well finance or money well finance. So let's assume these guys are the one engaged in giving us loan. So we come here, you enter the name as a vendor. If you have a balance with them, you can eventually impute them. So your vendors are your service providers and also your loan providers. Those that have provided loan to you, they are also your vendors. And then you can come here, you have your direct cost. We've already set up your direct cost of the system, which is your cost of funds, your interest expenses, and interest on customer deposits. So how do you create an invoice for loan disbursed? So all we've done so far are basic setup that we need to start posting transaction. So everything we've done so far are basic setup to start posting transaction. Now, how do you record loan disbursement to a customer? Now, the implication of recording loan disbursement is that number one, your bank account is going to reduce by the value or the amount of that loan. Number two, the receivable balance in the name of that customer increases. Then the interest charges on that loan becomes your interest income, which will be reported or reflected on your income statement. And also your receivable challenge, your receivable balances also increases by that amount, meaning that the customer is supposed to pay you your principal portion and then your interest portion. So if you go to create invoice, this is what we use for loan disbursement. Now, rather than calling it loan invoice, you can change the name to loan disbursement. So I'll come here, I'll go to customization and then change the name from invoice to loan disbursement or loan disbursed to customers or cash advance, whatever name I want to call it. So let's call it cash advance to just make it easier for us to record. So you have your cash advance, and then you can say cash advance number on the system. So we save this. So you can do your basic customization, but this is just what we need. So you don't need quantity. If you want to set up quantity, you don't need that as a loan company. So you come back here, go to column. So we deactivate the quantity on screen. We can also deactivate it on print if we need to print out this statement or this invoice anytime we disburse to customers. Now, how do we record cash advance to customers? We want to disburse money to Mr. Smith. We go to Mr. Smith. Remember, if you go to your report, customers and receivables summary, you only have SMB, which is the customer that owes us. Now we want to disburse loan to Mr. Smith. So once we post the transaction, we want to see how it will reflect in our customer balance summary or customers and receivable balances or loan book. So loan book will show list of the customers that are owing us and then their irrelevant interest charges. So this is Mr. Smith as a customer. So what's the class of that loan? This is personal loan, which you select as a class. Now, what are we disbursing to him? We're giving him personal loan. How much are we giving to him as loan? You can say we're giving 100,000 USD. You can see 100,000 USD. Then the interest charge, which is the interest portion of the loan, it will be interest on personal loan. So you can see here the interest on this loan is 5%, which is what we're disbursing to him. So that's why you have. So in total, he is supposed to pay back 105,000 USD. So what happened is that in our record, our bank balance automatically reduces by 100,000 USD, and then our interest income on this loan become 5,000 USD, and then total receivable becomes 105 thousand USD. So if I click save and close, we're going to check our bank balance, we're going to check our interest income, and then we're going to check our receivable report of Mr. Smith. Then what's the terms of this loan? He's supposed to pay back in 60 days. That will help us track loans that are overdue. With this, you're able to see whether a loan is overdue and then or a loan is long overdue or a loan is still within its payback period. So that way you will know the loans to follow up and the ones not to follow up. So you come here, you click save and close. First, we want to check the balance in our bank account for this loan that has been disbursed. You click on use register Bank of America. Remember, when we set up personal loan, we mapped it to Bank of America account. Click on OK. So you can see that we had 34 million initially. Now it has reduced by 100,000. So you can see. So that automatically means that our loan disbursement from our bank is correct. The second one we're going to check is the income report, profit and loss. You can see right here again, interest income on business loan is 5,000. You can see, and then you come here, you can see your 5,000 as interest income on your loan. Then we want to check our report again, customers balance summary. Can you see again? Automatically, it becomes the this becomes the total receivable in the name of this customer, 105. Can you see right here? 105. So that means we are correct in our customization. If the system is going to post them to the relevant account. Because if we didn't do our customization very well, let's assume we track personal loan to interest income. Total interest income will be 105, meaning that that would be wrong. So the only interest we are earning from that loan is 5,000, not 105. So let's try out again for another business loan that we're giving out. So let's say we have a new customer, and the new customer is Auto Check, Auto Check Limited. So this is a repair company, and they wanted us to give them a loan. You can come here. This is business loan, which is business loan. And then how much are we giving to them? We're giving them 750,000. This loan is due in when? You can add your terms of payment. So let's work with 60 days. Then the interest portion, which is under the business loan, interest on business loan, 4.5%. You can see here, so this is supposed to be 4.5%. Make sure the percentage is there. If you don't put percentage, it treats the figure as a number and not percentage. You can see here. So 33,750, which is the interest on that. And this goes to our business loan. So I can also click save and close. So if we go to our reports, profit and loss, you can see that the interest portion of that loan, you can see interest on business loan is this. So I think this is supposed to be mapped to, if it is 5,000, this is interest on personal loan, interest on personal loan. Yes, yes. So let's go back to item. System is reporting. Let's go back to right click, interest on business, interest on personal loan, right click, edit. So this is the mistake we made. This is supposed to be interest on business loan, not interest on personal loan. So it's already it's reflecting our report. So let's go back again. Yes, I think we're correct. Yes. So you can see interest on business loan, 33,750, interest on personal loan, 5,000. So if we go to reports, customers and receivable too, you can see auto check the total receivable you can see right here. And if I as well go to my bank use register and I select interest on I select Bank of America, which is you can see the 750 that was disbursed. So far, we can track how much has been disbursed from our bank: 100,000, 750 USD. So you see how this is reflected in our reports. So let's go on. Let's move on to the next one. How do you receive? We've talked about tracking interest charges. How do you receive payment or receive money for customer deposits? This is also another interesting part of this system. Now we use why we use invoice to receive payment to create loan that we're disbursing. Are we going to use invoice for deposit? No, we're not going to use invoice as deposit. We're going to use sales receipt. I can also activate receipt right here. We go to edit, go to preference, desktop view. So let's quickly turn on our receipt on the system. We want receipt to be displayed on the home page of our system. So you use invoice to record all the loan that you're disbursing. Then you use receipt to record all the deposits that you're receiving from your customers. So there are two different things entirely. So come here, you use receipts. So here we'll quickly change the name to deposits or savings deposits. Now, when we receive these deposits from our customers, they go to a bank account. So we can as well come to edit. We want to add deposit to on this system. The reason is that the moment you receive money, the system will require us to record deposit. But on this receipt, we already have the money. So why not activate record deposit on payment receipt immediately? So we'll go to payment section, we'll uncheck this. So this means anytime we receive payment from in QuickBooks, it goes to an undeposited fund account. So it's assumed that you don't know where the money is going to, which I don't like. So I like to uncheck this so that anytime I receive payment or go to sales receipt, I want to select the bank account where the money was paid into, not receive payment and then you go to record deposit. So let's go back to our sales receipt. So these are our savings deposits. We use it to receive money from customers. Now we have another customer that is giving us their money. So you can say ABC Insurance, for instance, or let's say ABC Incorporated. So this is one of our customer, but this customer doesn't take loan from us. Rather, they give us their deposits. to keep for them at a small interest charges. So we come here, you add item. You can see right here that we only have interest on loan and loan set up as a product. Now, another type of product we also offer is deposit. So you can come here and say customer deposits. Customer deposit is not your money. So what happened? Because it's not your money, it goes to a savings deposit account, which is a liability. Did you see that? So when you set up customers deposit, it goes to a savings deposit account, which is a liability, and then you click on OK. So what's the implication of this that we're doing? The implication is that the same way we gave out loan and our bank balance reduced and receivable balance increased, the same way we are also going to receive deposits from a customer, our bank balance will also increase, but this time our liability becomes higher. Why? Because this is not our money. So it creates a liability for us. So that means every money, all the money you deposit in your bank account are not actually treated as an income to them. They are treated as a liability. It's only when they give out that money to other customers as a loan that they are going to treat the interest income portion of that money as a as an income. So here we will come here and then we have another department. We call this savings deposits department. Then you click OK. So we are receiving money from this guy. And what is the amount? You cannot check quantity the same way I did the other time. So we're receiving 130,000 from here. And then where's the money going to? We have a separate bank account to receive deposit, and that's Wells Fargo. You click on Wells Fargo. So when you click on save and close, automatically what happens? This customer balances will increase. Why? Because you have collected money from this customer. Then another thing we can add right here is if you pay this customer interest on this loan, you can come here, you add other charge. You come here, you say interest charges or interest expenses or interest on savings deposit. This is an expense to you, which is a direct cost. So you can see interest expenses. What's the percentage? 1%. And then you click OK. You can see right here. So it means that anytime we're paying this customer, the total amount we're going to pay this customer is 131,000. Can you see right here? Now, this customer is not going to be the one to give us this money, because if I click on save and close, automatically our bank balance increases by this, which is not correct. You can see our bank balance increases by that amount, which is not correct. So hence, we are not going to save this. So this is what the customer is paying us the first instance, and then you click on save and close. Now, how do you account for that interest on deposit? You go to company, you select make journal entry. So it's going to increase the liability account of the customer, and then it's also going to add to your interest expenses, which is the direct cost to you, interest charges. So our deposits will be credited. Let's assume we have this, and then this will also be credited too. So you can say being interest payable to whatever customer that you are dealing with, and then you click on save and close. So that's how we set up deposits. But like I said, this training is designed basically for loan company. Then how do you receive payment for loan settlement? To receive payment, normally you could just go to your receive payment on the system, and then if you select any of the customer, let's say SMB loan, you can see here this is the customer that owes us. We come here, we receive the money. But let's look at customer that we just created an invoice for, Auto Check Limited. Can you see the total receivable balance, which comprises both the principal portion and the interest portion of that loan? You check this, sorry, you select the bank where the money is going to. Anything that relates to loan is Bank of America. You check this. 78 to 3. So let's say the customer paid us 700 right here. You can see, so this is the balance payable to the made part payment. And where is the money going to? Bank of America. You click on save and close. So if you go to your banking, use register, You can see a summary of your bank statement. These are the money you disbursed as loan. This is what you have received under deposit so far. Let's look at other areas. We have okay, you can also receive loan for the interest. You can also receive loan for personal, receive money on personal loan that you disbursed. So if you come here, you select this person. You can see this is the personal loan. So let's assume this guy paid back all the money. You say 105. So this guy has finished paying, going to this bank, click OK. So when you're receiving the money, you're receiving both the interest and the principal portion of that loan. So you have your regular business expenses, which I've discussed multiple times in my video. You use enter bill to post expenses that have been incurred and not paid. You use write check to post your regular expenses. So I just want to pay more attention to the loan business itself and not uh, uh, transaction entries that you already used to. So let's assume you also secured a loan from an institution. You come to company, you make journal entries. So that loan that you secured will be secured loan, secured corporate bond against your bank. You can see here, secured corporate bond against your bank. So you secured a loan of 50 million, you input it here, and then you can as well put the credit leg here. So you can see this being loan secured from whatever institution that's engaged in giving you that money. So you can say Moneywell Finance, which is a vendor, and this is tailored to maybe a business loan or personal loan. If it's not, you can just leave it like that. So you use this to record the loan that you have secured. Now, if this loan comes with a certain amount of interest that you're supposed to pay, that becomes your cost of fund. So this is where cost of fund come in. So cost of fund will help you track what you're supposed to pay them. You can see right here, cost of fund will be debited, let's say 10%, which is this, and then the secured corporate bond automatically increases by the same amount. So meaning that by the time you pay back this secured corporate bond, you're going to pay the principal and interest portion, and then for the debit leg, you see that 50 million actually hit your bank, and then your expenses will be cost of fund, which is a direct cost. You click on OK. So if we do this and we go to our reports, you can see how all these are playing out in your financial statements. You can see cost of fund 5, which is direct cost, interest expenses or charges. You can see the interest income on business loan, interest income on personal loan, and then you're able to see whether you're making profit or not. Now, this cost of fund, let me talk about it. The reason why we may not quickly classify this, I just want to make it simple. That's why I had to quickly record it here. You can see it's showing account into negative. Most times, your cost of fund are not supposed to be recognized in bulk as an expenses. You're supposed to split your cost of fund based on the period that the loan runs. So if the loan runs for 12 months, you're supposed to recognize this cost of fund on a monthly basis. So which is 5 million divided by 12. So that's something you can discuss with your accountant and recognize the monthly portion of this cost of fund as expenses so that at the end of the year you would have captured the other value. So the other leg becomes what happened to the other leg? The other leg becomes a liability to you. Why? Because it's like an interest owed or interest payable. So that is how you record your cost of fund. So let's look at the other parts of the system. Then your banking transaction and your financial report. Your banking transaction, you're able to check your use register, which shows you summary of all the bank statements. You can write check to post direct expenses. You can see right here from any of your bank accounts. You can also use enter bill to post expenses that you have incurred, meaning that if it's outstanding, you can use transfer funds to move money from one bank to another, maybe from Bank of America to Wells Fargo. Sometimes, if you have more money as savings and then you don't have much as for a loan, you can move the money from the account that is dedicated to savings into the account that is dedicated to loan, so you can disburse to your customer. So that's what transfer fund does. So if I'm moving money from, let's say we're moving money from this account from Wells Fargo to Bank of America, we're moving 446, so that we can have enough fund to disburse. can see here. So it means that the balance in that Wells Fargo account would have reduced. Can you see? Because we made a huge payment into Bank of America. And then if you go to your use register again under banking and you select Bank of America, you see that the money is already reflected right here, which increases our balance to 88.5 M. Then everything we've discussed already, they've made our report so easy. We can check our profit or loss by class. So you can see right here, you're able to see all the loans by class. And then we have our statement of financial position right here. You can see, you're able to see all the balances in each of your bank accounts. You can see all the payables. Your payables are your savings deposits, which is the savings you collected. Your payables are also your corporate bonds, which is under liability. So this is exactly how you can use QuickBooks to manage your loan company. Any other thing you need to know about your loan company, most especially, you can reach out to us for guidance. But I think with this basic customization as a lean loan company, you are able to use QuickBooks to manage all loan disbursements, savings, interest charges, direct costs on your loan. That is the loan that you're giving out, and also direct cost on the loan you have secured from your provider. So I hope this video is able to guide you on how to set up QuickBooks for your loan and lending company. So if this is the first time, you can actually turn on notification or click the subscription button for updates whenever I share more videos. And if you have a business that I've not mentioned, or maybe you have business in different industries, or you're looking for a guide on how to use QuickBooks for your business, you can actually use the comment section to drop your question. I may probably consider your industry